Hi, what's up? Jason here. Recently, I posted on Facebook my earnings from last year's portfolios and the stocks I bought, and I got a lot of questions, both asked on the post and private messaged about my thoughts about investing when you're starting investing, and also how I learned to invest and how I invest, how I choose my stocks. So I actually thought I'd make a blog to show you guys how I invest. And for those of you who don't know me, my name is Jason, and I'm currently a third-year finance student at Concordia University. I've also begun studying for my CFA, which is a Chartered Financial Analyst candidate. I plan to hopefully work in investment, if not some field of business. And yeah, that's pretty much it. So, pretty much, how did I get interested in investing? It's actually an interesting story. What happened was I was driving with my girlfriend, and she was a very good student, and she always believed in the merits of education, and so do I to a point. I mean, I think education is important, but I don't think education is the defining factor of whether you succeed or not in life. Because luckily, when I was younger, I picked up the habit of reading, and I read lots of biographies and lots of books, and in a lot of the biographies I read of successful people, they never finished college or they didn't finish high school, and I even knew people from my own life who didn't get that much traditional schooling and did it exceedingly well. You know, millionaires and happy and successful. What I do believe is important is schooling, but not necessarily formal education. I believe you always have to keep learning, but it doesn't necessarily have to be through traditional sources, although traditional sources have their merit. So, anyways, we were having this debate, and she said, "Well, if you don't think school is that important, how are you going to make money? If you don't get a degree and then get a job or profession, how are you going to make money?" And at the time, I said something like, "Oh, I'll buy a franchise," because that's what I thought about. But the truth was, I didn't really know. I just knew that it was possible to make lots of money from non-traditional sources. So what I did was, I was thankfully self-aware enough at the time to realize I didn't really know, and it made me curious. So what I did was, I did what I always do when I'm curious about something. I went to chapters, and I just looked around the sections, and I saw a book about this guy named Warren Buffett, who was the second richest person in the world. And I actually went there and I bought that book that day, which was this book. This is when I was 17 years old, and it's a huge book. So I pretty much spent that summer reading that book. And this book totally changed my life because it opened my eyes to the world of investing. So uh, another thing I'd read before I'd read uh, this book and another book was something called modeling, which those of you familiar with Anthony Robbins or neurolinguistic programming will be familiar with. And what that is, if you want to accomplish something, what you do is you find someone who's succeeding in whatever you want to accomplish and you copy their strategies. So that's pretty much what I did. I wanted to copy a strategy. So what I learned when I read that book was that he learned from most of his investing philosophy from someone named Benjamin Graham, who wrote a book called The Intelligent Investor. So I went out and I bought that book and I read that book, and that's this book right here, which is also a pretty big book, and also quite a tough read, but very amazing read. The guy's logic is flawless. It's an awesome book. So I read that book, and it kind of created my philosophy of investing, but I still didn't know the mechanics of investing. So what did I do? I went out and bought another book, and that's this book right here, which is Security Analysis, and this is an even bigger book. Now, these two books I understood. When I read this book, I unfortunately did not understand a lot of it. Most of it was over my head. I'd say about 80–90% of it was over my head. And the reason why was because I didn't understand basic accounting, and I also didn't understand basic finance, which is pretty much the time value of money. So that's when I was coming out of college, I decided I wanted to study finance to understand these things because it really fascinated me, and I thought it was a great way to make money. And who doesn't like making money? So I went to university and I studied finance. I'm still studying it now, and really, I just kept reading these books about investing, and I just kept reading about books people have written about Warren Buffett and other people Warren Buffett read. I read this book, Common Stocks and Uncommon Profits, Philip Fisher, an amazing book, highly recommended. And I read this book, Peter Lynch, Learn How to Earn, great book. I read Buffett's bio again. That was an awesome book. And I read another Peter Lynch book, One Up on Wall Street. I read dozens of books about investing. And what I really deciphered was, what are the people who are succeeding? What are they using to succeed? You know, because it's great to have academic theories about what works, but when someone goes out in the real world and proves it, that's an entirely different thing, right? So I read these books, and after I'd taken my intro to accounting class and my intro to finance class, I pretty much all of a sudden it clicked in my head, and I understood how to invest. You know, I understood what the difference between a good investment and a bad investment was. Of course, you can always improve and make finer and finer distinctions and become a better investor. That's what's awesome about investing. You can always improve. It's like a sport. You can always get better. But at this point, I knew that I could pick a good investments. I knew it. And until then, I refused to pick stocks. I bought mutual funds because that would be speculation, you know. And one of the things Benjamin Graham talks about is the difference between speculation and investment, right? And I want to be an investor, not a speculator. So in order to be an investor, you have to be able to properly analyze a stock. So once I realized I could pick a stock, I started reading the Wall Street Journal. I started going on MSN Money, Yahoo Finance, just browsing stocks, and eventually I found a bunch of stocks that would be great investments. And the thing with the way I invest is there's no really way to tell what the best stock is. There's no way to tell, oh, this stock will earn you this much. What there is a way to tell is that this is a good investment. So what I did was I just picked the investments I thought were the best investments with the money I had. You know, if I had more money, I would have bought maybe a few more stocks. You know, but I don't believe in too much diversification for me personally. You know, if I was managing someone else's money and they're a bit less risk tolerant, then yeah, there'd be more diversification. So that's pretty much how I learned to do it. You know, and along the ways I learned a lot of cool things. So what I'm going to do is I'm going to make a blog. And what this blog is about is every day, it's called astockdaday.com. So every day I'm going to analyze one stock. I'm not going to go too in depth, especially at the beginning. Maybe more and more I'll go more in depth. But I'll just give you a general idea of what I think of the stock and why I think that way. And then I'll give a buy or not buy recommendation. I don't believe in shorting. I don't believe in selling calls and all these things. I just say buy or not buy. If it's a good stock, you buy it. If it's not a good stock, you don't buy it. That's it. You know, maybe in the future I'll get more of those complicated things, but right now I don't deal with those. I only deal with what I know, which is you either buy or you don't buy. So what this blog really is about is about making small changes over time, you know, and it's about making a 1% improvement in your knowledge and your ability to invest and with your finances. And what's amazing is that 1% compounded over time can have amazing results, you know. That's what investing is really based off of. If you compound interest money over time, you can get amazing results. And what I realized through reading all these books is that really anyone can become wealthy. That's truly true. You know, and you don't have to be an entrepreneur. You don't have to be any of these things. If you love your job, if you're a professional, if you like having a 9 to 5, things like that, you can become just as wealthy as anyone. You know, if you would have invested $10,000 with Warren Buffett in 1965, it would be worth 50 million today. And he gets on average 20% returns a year. The stock market gets on average 10%. You know, even if you just invest in the general stock market, 10,000, 1965, you'd still have amazing amount of money today, you know. And if you invest even more than that every year, you can retire wealthy. I won't go into specific numbers now. Maybe I'll do that in a later post about you can calculate exactly how much you invest and how much you get based on interest rates in the future. But right now, just let me tell you that yes, anyone can retire wealthy. Anyone can become wealthy in a 20-year period for sure. You know, for sure, guaranteed. 20 to 30 years, you can become wealthy. So what this is about compounding your knowledge of finances so you can make your own finance decisions, you know. Finances to me is something like health. You shouldn't place it in someone else's hands. You should have an understanding for yourself. You know, it's such a critical important area of your life. Would you put your intimate relationship in someone else's hands? You know, I wouldn't do that. So, you know, and we're going to do 1% a day. And if you think, you know, 1% a day improvement, it isn't that much. But over time, compounded, it really adds up. If you took 1% every day, just simple interest, it'd be 365% improvement. Even that alone is a huge improvement in any area of your life. But if you took 1% and compounded it, the percent on the percents every day, at the end of a year, you have over a 3,000% gain. Now that is an amazing gain. You know, if you took any area of your life and improved it by 3,000%, imagine how awesome that area would be. So that's what I'm gonna help you do here, you know. And I'm gonna give tips every day, you know, a few tips every day. Every now and then I'll come up with a longer post with more big tips, and I'm going to analyze a stock every day. And I'm not going to analyze it too deeply to begin with, but as I go on and as you learn more of the concepts and the ideas, I'll go more into depth about my analysis. So for today, I'm going to talk about Best Buy. And I'm not going to go too in detail. You know, I'm not going to show any of the financials, but I'll just give you some of the reasonings of why I bought Best Buy. And that was my biggest earner in my portfolio. You can check it out down there. I'm going to post it. So why did I buy Best Buy? You know, the reason I bought Best Buy, I was actually reading the Wall Street Journal. And when I read the Wall Street Journal, what I do is I look for stocks with negative press. And the reason I do that is because I want to find stocks that are undervalued, which means they're trading below the level that they should be trading at, their intrinsic value. Okay, and intrinsic value isn't an exact number, it's an approximate number. So it's around this number, this is where it should be, and it's way down here. And the further down it is from where around it should be, that's called your margin of safety. That's how likely it is you'll get a big return, right? And we'll go more into, that's the real trick of investing, is how do you determine that intrinsic value, right? But anyway, so I found Best Buy and I found some bad press about it, that they were changing management and it was a bad thing. So I said, okay, let's see, everyone's saying it's the company is doing bad, let's go check it out and see if it's true, right? So I went on MSN Money, I looked at the stock and I noticed that they had negative earnings for that year. Wow, okay, so I thought, okay, so they had negative earnings, but I looked at the years before, all the earnings were very, very stable. You know, it was very stable earnings. So I'm wondering, is this a one-off scenario where their earnings will be depressed? If that's the case and the earnings return back to normal, that increases the chance that the stock could be undervalued. So I go and I check and I look around a bit. I read some news articles about it. I look at their annual report. I find out the reason that they had negative earnings last year was because they sold off some stores. And when they sold it off, they had a capital loss on the stores. So because they sold off some stores and they had a capital loss, they had negative earnings for that year. But think about it. If you sell off stores that are losing you money, right? Every year, this store is having a negative result on your earnings, right? Wouldn't after you sell those stores, the next year your earnings go up, right? So what's funny here is that the general public just looked at, oh, negative earnings, sell, 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 right? They just speculated. They didn't look deeper into it, you know? And because of that, the stock price was severely depressed. It was not anywhere near valued where it should be, right? So what did I do? I bought the stock, you know? And another interesting story about this. So the first thing you learn here is that misinterpretation of information will cause prices of stocks to be not properly valued, right? And you as an investor, by properly looking into this information, can seize that opportunity to buy undervalued stocks. It's like Warren Buffett says, it's like giving a dollar to get $2, you know? The market is overly optimistic sometimes and overly pessimistic. When it's overly pessimistic, that's your time to buy. You know, it has to be in a good company. You know, you can't buy the wrong company at a bad time. But a good company at a right price. That's what we're looking for. And when I really knew this was a good buy was actually when I went to my friend's house and I told him about it. I said, "Wow, I found this deal. It's amazing. I mean, it's the best of. I've been looking around. This is the best of all the stocks I've found. I think it looks amazing. You should buy it. I'm gonna buy it. I'm gonna tell everyone to buy it. I told my cousins to buy it. I think I told my uncles to buy it. I said, everyone buy the stock, you know?" And he says, "Yeah, that sounds good. That sounds good. You know, my dad was looking to put some money into stocks. Let me go ask his opinion." So he goes and asks his dad opinion. His dad says, "Oh, I hear bad things about Best Buy. You know, I hear their earnings are down, and I saw a Best Buy close down the street. You know, I think Future Shop's doing better." You know, I said, "Wow, a Best Buy closed down the street. I mean, I knew they were closing stores, but maybe they're not. Maybe they're not doing that." So I double check, you know, and I check, and I find out that Future Shop in Canada, Best Buy owns Future Shop. That's why they're closing the stores. Wow, you know, and the fact that even his father, who's a very successful businessman, you know, even he doesn't look, he can't see beyond that. He can't look deeper than that, you know. And there's lots of people who can. That means it's even better buy. And it's kind of funny. It's kind of fitting that my best buy, the stock, was my best buy. Okay, that was a bad joke. But But that's kind of the rationale. And what's really key here is you want to go against the grain. When everyone's selling, 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 you want to be the one buying because that's when you're getting the best deal. So a lot of investing is just being, a bit weird, a bit eccentric, not like everyone else. You gotta follow you gotta follow the beat of your own drum. And it's like Charlie Munger says, um, following the herd invites regression to the mean. And what that means is if you follow everyone else, you'll just get the average return because you're doing what the average person does. If you want phenomenal returns, if you want outstanding returns, you have to do things that the 1%, you have to be the 1% who recognizes an opportunity when it's time to buy, when everyone else is selling. And luckily enough for me, that's what I was able to do with Best Buy. And I did pretty well with the other stocks I bought too. So that's it for today. I hope you follow this blog. I think you can really, really learn a lot about investing. And if not, I hope I was somewhat entertaining. Anyways, thanks a lot.